Hey everyone, welcome back to another episode of AQ Markets. So today's topic is going to be something that is incredibly important and incredibly crucial to understand when you're getting started with investing, and it also pertains to everyday life, and that is risk. Risk is the chance that an unfavorable event happens. When you get in a car, there's a risk that could be a car accident. When you get on a boat, there's a risk that the boat can sink. Typically, we like to go and stray away from these kind of events, and there's measures we could take to avoid that risk. The same thing can happen in investing and in the stock market. So in finance, risk is defined as the chance that an investment's gains differ from what was expected. Obviously, when we're making our investment decisions, we want the stock to go up in value. We want the bond to be in good condition where they make their payments and pay their residual values. But there's a risk associated with that where that doesn't happen. No matter what you invest in, there's always going to be a risk associated with it. There's no such thing as a riskless investment. The closest proxy we have to that are US bonds. Though they are considered riskless investments, at the end of the day, it's not really safe to say that this is 100% immune to defaults. So we just kind of consider it a riskless asset when in fact we're just going to say it's 99.99% safe. So with that being said, why would you want to invest in risky stuff when we could just invest in safe stuff? And this is where the relationship between risk and reward comes into play. When you are increasing your risk, there should be a higher return at the end of that decision. And just to be very proper on how we define it, the higher the risk, the higher the potential reward could be, but at the same time, the lower the chance that that reward will happen. So that's basically saying that, okay, this is a risky investment, the reward can be great, but it might not pan out as well as you think, and the underlying investment could go defunct or bankrupt or whatever. So when we look at comparing riskiness in stocks, we can look at it from this way. We have blue chip stocks like Apple and Microsoft, IBM, these big name brand stocks that everyone knows. They are typically more safer to invest in, but at the same time, you're not going to see a crazy realized gain over time. You're going to see more steady growth, you're going to get dividends paid out, and it's going to be a much less stressful time investing. On the contrary, we have different types of industries and different stocks that might be a little more risky. Just the easiest example would be penny stocks. If we're looking at penny stocks that come from companies that are just starting out, there's a chance that they can skyrocket in value and double and triple over time. But at the same time, there's a really high chance that they might just go bankrupt and you might not be able to realize that gain. So while the reward is great, the risk is much greater. So with risk in the stock market, there's two main types of risk. There is systematic risk and there's unsystematic risk. With systematic risk, these are risks that will affect the whole economy. They're considered market risks. And some examples of this would be natural disasters. You know, if a tornado wipes out the whole middle of America, then that is something that no one really predicted, but this, no matter what, will affect every single industry and business in that area. There's also war. During wartime, typically stock markets are very volatile. They fall a lot just because of the uncertainty of what's going to end up happening. And there's also legislation and government changes that could happen in a certain country. For example, like tax reform. If taxes go up or down, that is also going to be a systematic risk that affects the whole economy. The other type of risk is the unsystematic risks, and these are risks that are going to affect more so a specific company or even an industry, but not the whole economy. Examples of this could be competitive changes where there is new technology implemented and the certain company just can't adapt to these changes and ultimately ends up getting pushed out of the market. It could also be something as interesting as if there is a CEO scandal and the CEO gets fired and now there's a lack of leadership for the company. And in some cases, it could be like a product being recalled. This happens a lot with the auto industry when certain products or car components get recalled, and there's a massive lawsuit that can ensue, and they also have to pay millions, if not billions of dollars to fix this product and give the money back to the consumers that purchased the products in the first place. Alright, so why am I talking about risk, and what is the key takeaway from this video? The key takeaway is that not all of your investments are going to be winners, and that is totally okay. No investor, no hedge fund manager, no stock guru has ever had a 100% hit rate. Even the great Warren Buffett, the godfather of investing, has taken some losses in his portfolio. A great example is he recently dumped all of his airline stocks. And he even admitted saying that he sold them at a price lower than what he paid for them. So even the greatest investor of all time has not had a 100% hit rate. Another key takeaway from this video is understanding that your risk can be mitigated. As I mentioned in the beginning of the video, when you get into a car, there's a chance that you could get into a car accident, but there are risk mitigation measures taken to ensure that you are safe and to ensure that you don't get into a car accident in the first place. So in the same way, with the stock market has risk mitigation methods for you to incorporate into your portfolio. And the one mitigation tool that I love, and it's my favorite word in investing, is diversification. Diversification means that you are not just focusing on one certain stock, or you're not focusing on just one certain industry. You are buying all sorts of different things in the expectation that over time the wealth will be generated and it's going to trend up in a positive direction. Obviously, not all of our stocks are going to be winners, as I mentioned before, but let's think of it this way. If we are invested in 10 different industries and one industry has a particularly bad year while the other 9 are doing okay, then only 10% of our portfolio is going to be experiencing some sort of trouble. On the flip side, if I just went all in on that one industry and that industry doesn't do so well, I'm not losing just 10% of my portfolio, I'm losing 100% of it. So diversifying is an extremely important tool to use when investing. When you're constructing a portfolio, consider the industry, look within that industry and understand what are the systematic risks, so what would affect the whole economy, then look one step deeper and look at the unsystematic risks. What sort of risks are going to affect this industry or these stocks alone? Take that into consideration and then understand, okay, so do I want to go really heavy into this industry or stock? Maybe not. So what you should do is allocate a small portion towards it, then take the rest of the portion and allocate it into other areas as well. As always, thank you so much for watching. I hope this brought a lot of light on understanding risk and also understanding that you can mitigate risk in a portfolio through diversification. If there's any questions you have regarding risk or understanding what sort of risks exist in a certain industry or my thoughts on certain industries and what is the major risks associated with them, please drop a comment below. Tune in for the next video. Don't forget to share the videos with a friend and also like the video because apparently that helps with YouTube algorithms or something. Thank you guys. See you next time.